I will be joined in this panel by my colleague Alyssa Gilbert, who's Director of Policy and Translation at the Grantham Institute. She will help me moderate this session. So as a first speaker, I would like to introduce you to Liz Renelleau. Perhaps Liz, while I say a few words about yourself, you can start sharing your screen. Okay, Liz is Head of Sustainability for the quantitative investment platform at AXA Investment Managers. She had a long career with AXA, developing a number of sustainable factor strategies. And she has focused on ESG and SDG integration for the past 5 years. And she's also supported climate initiatives across AXA Investment Managers. Now she's just shared the slides. I think they work perfectly well. So Liz, the stage is yours.
Thank you very much for inviting me to speak today. So I'm going to represent the asset manager's perspective, and in particular, I'm sure that what I'm going to say will be echoed by some more in-depth views by Iann later, how the regulatory landscape is changing and how investment managers need to take action and basically own the future of climate investing in particular. So just a very quick reminder as to why we're doing that. So the United Nations have basically identified a whole load of UN Sustainable Development Goals that we all need to try and protect our assets in the very long term. We need to try and achieve those, but in particular, well, before all of that, we do know that the climate is a very key emergency and other environmental challenges that the planet is currently facing. So the issue is that between 2010, when it was starting talking about the need to get to net zero, and now basically emissions have not reduced. So the emergency is worse and worse. So regulators have seen an increase in asset under management in ESG product and in a climate product in particular. Morningstar just reported yesterday that there's 117 billion of funds that have climate as their main Simm, mostly in Europe. That number has almost tripled in 1 year. So the regulators are really in a position where they need to do several things. One is reorient capital towards sustainable investment and in particular climate solutions and green investment, manage the financial risk, which are long-term risk as well as short-term risk associated in particular stemming from the climate change and the environmental degradation, but also social issue, even so that may not be the immediate priority of regulators. We've just heard that's going to become a big one soon. And then also the question of fostering transparency and basically creating an environment where long-termism becomes more common in financial activity. The problem is that there is a big challenge. We need a completely new ecosystem in order for asset managers and portfolio managers to be able to deliver on that pledge. There is a whole range of methodology. We all know ESG scores are all different. Well, I have bad news for you. It's a little bit the same for climate alignment because there are some very clear interaction between the various issues within climate. It's not a simple solution. The lack of harmonized data we just talked about is obviously a problem. That doesn't mean we cannot do something today, but obviously investors need to participate to this idea of increasing and harmonizing disclosure about those problems. And finally, there is a need for a general ESG and climate taxonomy, and not just about the taxonomy of the actual activities that the issuer engage in, but also the taxonomy of products, because they are multiplying by the day. So it's never very good for an industry to be following the regulators. So I think the push from various regulators has been a very strong wake-up call for our industry to really start leading the way of innovation and rather than just be reacting to regulations. There's an increasing number of net zero carbon pledges by financial institutions, but also also a whole maze of initiatives and frameworks. So this provides us with a very good and useful public debate, as well as education opportunities. At AXA and AXA IM, we're participating to several initiatives. The Asset Owner Net Zero Alliance, the Net Zero Asset Manager Initiative, the IIGCCP Paris Align initiatives, the AXA's just launched an insurer initiative. So there are many of them. Most of them agree in principle, but at the moment they don't agree as much in the details. So it's very important that these initiatives continue so that we can reach that point of harmonization at some point, but that's not the case today. So it's very important that investors understand the frameworks, understand what we're trying to do, even if it requires to invest time and resources. But you need to, as an investor and an asset owner, to decide where you stand in terms of responsible investing and climate policy, and how your view might differ from some of those frameworks. So what we are suggesting and what we've done at AXA IM is to really start from very broad climate investment principles and basically define how portfolio can support the Paris goals. The idea is to reduce by almost 50% by 2030 real world carbon emission and to achieve a net zero carbon world by 2050 in order to keep the temperature rise below 1.5 degrees with a good probability. So in order to do that, we need to allocate at portfolio level in a way that helps decarbonize the portfolio, but also engage with companies that are carbon intensive, but are on the way to transition in order to decarbonize the real world. But we also need not to forget that it's not just about reducing current carbon footprint. We also need to finance green companies and climate solutions in any way we can and incentivize companies to invest in that kind of technology. So in order to do that, portfolio managers need a toolkit to really select issuers and perform detailed company assessment using either external or proprietary models, but they do need a very clear guidance and understanding of the tangible actions that companies are making in order to go towards a low carbon economy. In the end, obviously, you need to be able to have climate KPIs and monitor the progress of your portfolios, of your issuers, and how you're doing and how the market or the world is doing in achieving this ambition. So in the end, our view is those objectives, those principles need to really coexist with the mandated investment objectives. So they need to really be something that becomes part of the portfolio manager's investment process. So it is very essential to provide education and tools to portfolio managers who make the investment decisions in order for them to be able to own that decision and that alignment. Unfortunately, that requires quite a lot of data. We've seen already a lot. One of the things that I want to say today is that it's very important to understand that carbon as a KPI is the ultimate objective for the world, but it's not the only KPI that you need to take into account when you invest in this way. And in particular, if you decide to just reduce your carbon, you will just divest from the highest incentive sectors, and hence you will not actually participate to the real world decarbonization unless you decide that you don't need any energy or any utilities or any transportation in the future, which obviously wouldn't bode very well for assets and economic output. So what we are showing here is that there is an aspect of decarbonization so far. So where is a company in terms of their carbon intensity? Where are they versus a peer group? It needs to be a peer group that's relevant for their emissions activity. And then looking at that, what have they done to reduce their emissions in the past? What type of product and what type of climate solutions do they offer that mitigate climate change versus that actually obstruct or participate to the negative impact on climate change? And so you need to look at this kind of things. what happens, and obviously the overall environmental and climate policy that those companies have. Overall, that will help you identify low carbon leaders, transition opportunities, and green enablers. But you have to realize that in order to invest in transition opportunities and green enablers, you might have to accept a higher carbon footprint today. And I would say that's one of the things that maybe today is the least understood in the marketplace. Finally, having said that you need a lot more data, you will eventually get to a point, and we will all get to a point where we have a lot more things to report and to say about the climate behavior of our portfolios. You will see things like projected carbon intensity for your portfolio and your benchmark, climate value at risk, or a function that will show you how much your asset under management is exposed to the risk of carbon pricing going up, as well as the risks, the opportunities associated with the technology change structural change that we are experiencing. You will also have to monitor how many targets, how many companies. There aren't many companies who have science-based targets today. You also end up monitoring this kind of thing. And finally, and maybe most importantly, you need to monitor how much portfolios are allocating to both green products and climate solutions and basically climate R&D that will help us solve the problems that we are facing today. So I'm going to stop there, and I don't know if Iann will talk first, and we can take question later.
Thank you very much, Liz, for the insightful presentation. Now I will invite Iann to share his screen. So perhaps, Liz, you can stop your screen share. Fantastic. Hello, Iann, welcome.
Hello, everybody. Good to be here. Thank you.
Everything seems, yeah, we hear you loud and clear. So while Iann set up his screen, shares his screen, I will say a couple of words about him. So Iann Simm is the founder and CEO of Impax Asset Management. He founded Impax in 1998 because he was passionate about pursuing the opportunities to invest in the sustainable economy. Today, Impax is one of the world's largest investment managers focused on this area, and it has a global footprint in terms of staff and institutional clients. So very much looking forward to Iann's presentation.
Yeah, thank you. So hello, everybody. I was captivated by the idea of sustainable development back in the late 1980s when I was graduating in natural sciences and trying to work out what to do with my life. And so for more than 30 years, I've been passionate about trying to help sustainable development. And in 1998, as Enrico said, I realized there was a huge opportunity to back really rapidly growing companies that were solving environmental problems. And so Impax Asset Management today is managing over $40 billion in essentially just doing that. Now, in 1998, ESG didn't exist. It was coined as a phrase in 2004 by some clever consultants who wanted to raise topics around ethical investing and governance at a UN conference. And since 2004, it's really become center stage for investment managers. But it's a rather curious concept. It puts together external factors and internal factors. It's not completely comprehensive. And as everybody knows, it's quite difficult to come up with definitions. And so at Impax Asset Management, we're finding it very helpful to think about ESG not as a literal collection of three terms, E, S, and G, but rather as a prompt, a reminder to do a better job in what are essentially the three steps of investment management, of managing money. Firstly, agreeing investment beliefs with your stakeholders. What is it that your money is trying to achieve, and how do you think it should be? How do you think it should be run? Secondly, looking for opportunities, and thirdly, managing risks. And so, what I'd like to do is just give you some sense about how Impax uses ESG as a prompt in those three areas, particularly around opportunity and risk. So today, we are looking for opportunities in the transition to a more sustainable economy, really using ESG type tools in three areas. First of all, how do you create a manageable investment universe where you can really sensibly analyze a number of stocks without getting lost? Secondly, once you've found companies that are interesting, how do you do deep analysis to understand their potential and the risks that they're facing and the risks that they're managing? And thirdly, if you do find a company you like and you buy a position, what can you do to improve the quality of that company and help the management and the board to improve expected outcomes? So I think investment management is both an art and a science. It's not easy, but if you can find ways of rapidly reducing the number of available opportunities, there are 60,000 or so, or maybe more, listed companies around the world on recognized exchanges. And you need to be able to cut that down dramatically. Back in 1999, my colleague Bruce Jenkins-Jones and I came up with a classification of what we call environmental markets. And this was in response to a Scandinavian client who was interested in environmental investing. And we wrote one of the world's first green taxonomies defining those sectors that were solving environmental problems. That's been adopted.
Ian, I'm sorry for interrupting. Just a couple of, since we have some question from the attendants. So the audio is not particularly clear. It comes and goes, and also we can't see your slides. So would you be possible to try again?
Oh, sorry.
Thank you, Jeremy, for pointing it out. Yeah.
Thank you very much. How is that? Is that any better?
I don't seem to be able to see your slides. We can, okay, perfect.
How's the audio? Is that better now?
I think it is, and we can see your slides.
Tell you what, we don't need the slides. I'll just keep talking.
Okay, then you will have to stop sharing your screen. Yeah, perfect.
Okay, do interrupt me again if my audio is not working very well. Sure. So, yes, Investment Universe, back in 1999, we came up with the idea of environmental markets, which is a construct to select those areas of the economy that are solving environmental problems. That's led to the creation of a universe of around 2,000 stocks, which are all demonstrating high levels of market growth, and it's a very interesting framework for the selection of securities. The second thing we did just over 7 years ago was expand the environmental markets construct into what we call a sustainability lens, which is a way of looking at the 160 GICS subsectors to identify those areas that have got very strong risk and opportunity characteristics over the next decade. Now, in both cases, ESG is a prompt for the construct of these two frameworks, and they are proving very effective in giving a signal to our investment managers for where to look for securities. So ESG is really helping us in universe creation. Secondly, when it comes to stock analysis, then ESG is super helpful, not particularly in going through pedantically environment, social, and governance box ticking, but more in using a radar screen or radar sweep analysis of all the issues that one could possibly think of around opportunity and risk to give a complete picture of a company's attractiveness. And in particular, we focus on materiality. So ESG is really helping us, once we've gone through the universe creation step, to pick the right stocks. And then thirdly, as I mentioned earlier, the engagement that we do with the companies that we own is also crucially informed by ESG. Once we have gone through the steps of investment management, I think it's also really important to think about helping clients, not just in looking for opportunities, but also in managing risk. And ESG is being used very broadly as a way of taking a holistic view of issues, but people are finding it very difficult to come up with definitions. And so what's been most useful at Impax is using ESG in a much more focused way. For example, the use of scenario analysis for measuring climate risk in the transition risk sense, and then using that measurement to inform portfolio construction. So since 2014, we've been working at Impax, and actually with the Brevan Howard Center of the Grantham Institute, at Imperial College to develop and use a tool around scenario analysis for climate transition risk. And essentially what we're doing there is we're taking a view of the value at risk of affected stocks that have got real risk around transition, particularly regulatory intervention or technology change or changing consumer preferences. And the scenarios that we're using then can be used mathematically to inform a cash flow sensitivity, which then of course can be computed into a discounted cash flow valuation, which can then inform a portfolio optimization. So no time to go into detail, but broadly speaking, we're finding ESG to be super helpful, not in a broad sense around scores for companies, but in a very focused sense around how can we use insights to generate more information around risk or opportunity, which the market maybe is not yet pricing in. Finally, just some quick comments around the future. So I think there is now a huge focus on getting data out of companies to improve the analysis of risk and opportunity. We see that that process will lead to, on the upside, to better information, better assessment of risk and opportunity, more effective allocation through cost of capital efficiency, so cheaper cost of capital for well-positioned companies. And AI and machine learning come into improving the processes. I think potential pitfalls, I think it's already been mentioned in the conference so far, but there's a real risk that we'll drown in data, that companies are asked for unbelievable amounts of data from people who don't really understand why they're asking the question. We want the information requests to be focused, to be standardized, and to be decision useful. And I do think there is a real risk that we muddle up what companies are for by imposing too much ethical overlay on them, ethical overlays that maybe are inconsistent from one requester to another. So I think it's really important that regulators continue to act decisively and work in the center of this debate so that the investment community can come together using standards and metrics to make sure that the ESG momentum is maintained, but is also channelized and is effective. So with that, apologies for not showing the slides, but back to you, Enrico.
That was great. Thank you. Thank you so much, Ian. It's fantastic. Alyssa, would you like to kickstart the Q&A session then?
Yeah, thank you so much, Lisa and Ian, for your comments. They were very, very complimentary, actually, taking slightly different approaches to the question, which is really helpful. So both of you mentioned data, not surprisingly. So there have been a few questions in the Q&A, but before we get to those more detailed questions, maybe a more general question about data. You referred to there, Ian, at the end about the kind of potential of a flood of data or overburdening companies asking for data. And Lisa, you pointed out that there's lots of different routes for getting data at the moment. So with a view to us improving the types of data that are asked for, what would you each say you find most useful in terms of data that's provided at the moment? And where is the data just insufficient and requires a lot more digging or due diligence? Maybe if we start with you, Lisa, and then go to Ian.
Yes, I think there's a couple of things. There's obviously a lot of work on the taxonomy. As Iann said, there's already some taxonomies out there, but we need a very granular view of what companies are doing in terms of their activity. And that goes beyond just defining a flag, whether it's sustainable or not sustainable. But then there's a lot more complication around really judging their climate policy and how likely they are to really achieve their policies. So at the moment, the only really strong framework is your own analysis or as SBTI kind of validation framework. So I think that if we could get some more data around the type of investments that they're making and have some frameworks on that, that would be useful in terms of reducing the burden to work out whether a target is realistic or not for an individual company.
Thank you.
Yes, maybe to add to that, I think, as I said in my remarks, it's really important that investors try and standardize their questions. And I'm finding that TCFD is a very useful framework with its 4 components of information requests, if you like. So very keen to promote that. When it comes to specific data, yes, I'd agree with Lisa that taxonomies are very helpful. I don't think it's really healthy for governments to be the only voice of what is green. And we're seeing the real problems with the European system at the moment around political intervention. So having a partly privatized taxonomy system would actually not be a bad solution. And then finally, I think it's really helpful to understand the sensitivity of a company's balance sheet and future cash flow projections to carbon pricing. So that kind of specific data around what would the financial impact be of certain levels of carbon price in the company's jurisdictions, that would be really helpful in understanding the value at risk.
Thank you very much, Liz and Ian. I think we should address, there is a question by Benoit that asks, that's very much related to data. Do you believe there should be a common data lake or cloud in Europe in which all key stakeholders can gather data and set up common KPIs? It's very much related to.
Sorry, Enrico, would you mind just repeating the question?
Do you believe there should be a common cloud in Europe in which all key stakeholders can gather data and set up common KPIs? This is Benoit from NVIDIA.
Well, if I go first, I think that would be great in theory, but in practice, it wouldn't work very well. I think the market is most efficient if there is a strong incentive on individual investors to hunt the data themselves up to a point. So we do need a degree of standardization, but I think that's best coming initially from regulators around adoption, for example, TCFD, and then maybe around industry associations to try to identify what best practice looks like. And then we see a partial convergence over time for data coming out. And then on top of that, investment managers looking for alpha can ask their own questions. If we try and standardize everything, then there won't really be a market.
Yeah, I think it's important to accelerate the standardization so that we all start from a common basis, but a little bit like earnings, but actually more difficult than earnings, because earnings is very tangible. you can tell the number of dollars. So we need to find a way to have tangible data available to investors. But we need to be careful that the existence of frameworks and data doesn't stop innovation in the investment industry, because what we need enormously at the moment is innovation, both at corporate level and at investment level, in terms of how to get the right capital to the right solutions. So I think it's two stages, a bit like what Ian is saying.
Yeah, thank you for that. I think it's quite interesting. You've both brought in the fact that there's got to be a balance, really, between what's provided to everybody and then where you add your flavor and your flair that differentiates you as investors in your own marketplace, right? And so that, I mean, that came up a bit, Lisa, when you were discussing how you assess, in a way, the credibility of what people are claiming their companies are doing. And that's where you obviously bring in your own networks. So with that in mind, and without you obviously wanting to disclose your investment approach secrets, how do you compare or rank the different investment opportunities that you see when you've got this multiple reporting frameworks, that some of the people reporting are making different choices, there's some self-reporting. So how do you do that as investors on the investment side? Let's start with Ian this time and then Lisa.
Sure, yes, well, as I said in my remarks, Alyssa, we have a couple of frameworks that we use to filter the main universe of 60,000 equities down to a manageable number of, let's say, a couple of thousand stocks to then do some proper stock picking from. We go back to fundamentals around opportunity using taxonomies, either for pure sort of environmental green investing or alternatively signals across the broader transition to a more sustainable economy. For example, the digitalization of finance and dematerialization across, say, consumer sectors as well. So that's much more useful from our perspective, top down, if you like, than looking at companies' data or, for example, ESG scores, where we do find that there's a real problem with quality and consistency. And if you use those factors as filters, you can end up with a real sort of mix, heterogeneous sort of model of ideas.
Yes, so I think I'm personally more involved in the quantitative investing side, but I'll try and speak more broadly. I guess from a first principle, you have loads of data points, so you need to select both the providers if you're using providers or the data points that you think have the most quality in them, so they're the most. So that's a very first step. Once you've got that, I think what's important is to consider them in a more holistic manner, and also to identify that they are non-linear relationships. So, so for example, yes, you can try and filter all of the very high intensive companies, but you might not want to do that if they have particular activities that are actually positive. So is this idea, so what we're doing is we're kind of trying to get to a point of having a more of an idea of net impact. How likely is this company going to have a positive net impact on climate change over the foreseeable future? And is this company today too intensive or too far behind that even engagement, because you have to select who you're going to engage with. You can't engage with everybody. You can do that through industry groups like the Climate 100 Plus, but there's a point at much. So you have to at some point make some decisions as to, I guess, which company you're going to believe have a chance to go forward. But I would say that the main point is first select the right data and understand the data.
Can I just add one other point? So I think it's really important that we all recognise what the financial system is trying to achieve, which by and large is to pay claimants or beneficiaries, so for example, pensioners, or provide returns on savings. And so as we're looking at integrating ESG and climate factors, we have to remember that there's a potential trade-off and tension between ultimately generating cash to pay beneficiaries and claimants and solving environmental problems. And there are potential inconsistencies and road crashes down the track. So I think it's really important that the industry and certainly regulators call out what the priorities here. And it seems to me as though the most important thing is that financial institutions focus on what they're good at, which is paying beneficiaries by generating returns, and regulators structure markets and internalize externalities to make sure that issues like climate are properly priced in through, for example, mandatory disclosure of risk and clear sector roadmaps about what's going to happen in the transition, for example, of electrification of transportation or power systems. If we go beyond that, I think we can end up with a real mix of and inconsistency between objectives, and everybody gets confused.
Thank you very much, both Ian and Liz. Now we got a few minutes left, and I think there are a few questions that I would like you to address. So one is about standardization and convergence, for example, between carbon and green taxonomies. Basic questions: is there opportunity for convergence? Who's going to take the lead at a global level? Second question is a very hot topic. How about using carbon offsets as part of transitioning? Entirely free, up to you. Who wants to go first with standardization and then perhaps address the carbon offsets? So we go around 3.5 minutes.
Shall I talk about taxonomies?
Perfect.
Great. Okay. So we've been working with taxonomies in real time since 1999 at Impax and with FTSE Russell. And we found that there's real health in having different taxonomies to serve different investor needs. I think nuclear power is a good case in point. Some investors find nuclear power to be acceptable, others don't. I think that's perfectly reasonable. And having choice for investor groups to pick one or the other, or taxonomies based on one or the other, is healthy. And so convergence is not a good idea because green is not black and white. There are always trade-offs as to what's green and what's not green, and we need different taxonomy providers.
Yeah, I'll touch very briefly on the carbon offset. Also, I don't want to preempt because I know XIM will actually publish some views on that soon. But I guess as an asset manager, we've actually launched a fund with carbon offset reasonably recently in France. And I would say there's two aspects to it. One is that carbon offset should never be a replacement for actually having a strategy strategy, and that is true both at corporate or issuer level, whether big governments or others. They need to have first a strategy to reduce their actual activity emissions. And then the second thing is at a portfolio level, what we have found is that especially in the retail market, current carbon footprint is a very strong KPI. And if you want to invest in some of the companies who are transitioning or offering green products in some of the high intensity sectors, you increase the carbon footprint immediately. So to some extent, carbon offsetting, as long as it's not, it's clearly separated, so you're clearly demonstrating that the strategy you're implementing is a climate strategy. It's not any strategy. Carbon offset can be useful to maybe compensate for a period the investment into companies that you believe are going to reduce their emissions over time. But we need to be very wary about them becoming the easy way out and avoiding that kind of problems as an industry.
Fantastic. Thank you so much, Liz, and thank you, Iann, as well, for handling the standardization question and taxonomies.